Let's get in some bank perspective as well. Ashutosh Khajuria, ED and CFO at Federal Bank, is now with us. Ashutosh, first you can just talk to us about the transmission. How much of transmission has happened, and say if there is a decent big size rate cut which comes in today, do you expect transmission to now happen faster?
See, I think there will always be a lag between the rate cut and transmission. It's because of the nature of the composition of bank balance sheets. Banks do not borrow in, interbank market that much. They are more dependent on public deposits. In most banks, you will find on the liability side, nearly 90% of their liabilities are public deposits. And within those deposits, you have more of fixed deposits, term deposits. Even, few years back, savings bank also used to be a fixed rate at 4% for years together. Sometimes for a decade or so. So I think savings also was no less than a fixed rate of interest. So I think if we simply go by that, I think it takes time. Fortunately, in term deposits, almost 2/3 of these term deposits are with original maturity 1 year. So when original maturity is 1 year, you will have the weighted average maturity of the pool as a whole nearly 6 months or so, approximately. And this is the reason why transmission takes almost, 2 quarters to happen, and that had been the trend. So now the question is how much has been transmitted? I think about 15 to 20 basis points has already been transmitted, and it's quite likely that post this policy outcome, you would suddenly see more of cuts happening, and already banks are preparing for it, and they would have looked at their deposits portfolio and revised some of the deposit rates as well. So I think transmission would be clearly evident after this policy outcome.
What do you think is the need of the hour that RBI should be discussing today, or RBI should be doing? Do you expect greater than 25 basis point cuts? Because all the corporates, all banks, all NBFCs are talking about a significant slowdown.
So now let's look at the real interest rates, because the key lies there. And how do you calculate real rate of interest? Some people compare it with the current policy rate with the current inflation rate, but probably that is not the correct way of measuring it. Your inflation rate, CPI, is a YOY thing. Means whatever the CPI index was 1 year back and what it is today, it's a YOY percentage which comes out, which nearly is about 3.5% or so. Now look at 1 year back, what was risk-free rate of return, means what was 1 year treasury bill quoting 1 year back, because that's what the consumer would have got as a return on his investment, and that is nearly 7.24 or 7.25, nearly 7 quarters. So a guy who had invested in August 2018 would be getting a return of 7.24, and as against that, he would have corroded the value of his investment by about 3.5%, because inflation also is YOY. So that simply suggests that we are closer to 4% as far as real rate of returns are concerned, which is quite high and which is quite taxing for any economy to grow. So I think going by that analogy and going forward how the 364 days T-bill moved last year, I think there is a scope of rate cuts, but the thing is, how does the present CPI numbers behave? Because there could be a risk on account of maybe deficit in monsoon. Of course, a lot of it has been recovered, but still, if there is a deficit and you have some gap in food production, then I think in CPI you have 45% weightage to the primary 45% is nearly food articles and all that, and that would play its role. So you have the risk on the crude oil prices because of the geopolitical conditions developing in Gulf. And also, the countering that would be the trade war between the two giants. So on one hand, you have pressure on oil prices. On the other hand, you have the easing of oil prices happening. Till now, it has been balancing, and therefore Brent has been between 60 and 65 for a pretty long time. If it continues there, and you have inflation going up to 4% also in the near future, which it is not likely immediately, but then post September it's quite likely to move towards that direction. If that happens, I think there would be a scope for more rate cuts. Now the question is whether they do it 50 today or 25 today, and going forward, pace it. But these two risks would remain. Oil price would be one, and the rising CPI, expected rise in CPI would be another one. If these are not there and growth continues to be as subdued as it looks like or as it is being perceived, more of it is perception than the actual numbers and all, because the business confidence and investment decisions are more on perception rather than the actual numbers, because actual numbers are historical numbers and perception goes for the future decisions to be taken by the investors, savers.
Okay. Hi, Mr. Khajuria. This is Mubina as well joining into the conversation. One factor that a lot of banks have given us, based on our prior conversations with them, is that while credit growth is happening, the deposit growth is not happening with the same pace, and that is something that's causing them as well to perhaps only transmit partially the RBI rate cuts to its borrowers. Would you believe that that is something that you're still witnessing, that while credit growth is happening, deposit growth rate is lagging behind credit growth?
I think we'll have to look into these numbers with more precision, because I think when we are seeing credit growth, probably we are seeing the credit growth in banking sector. What we need to see is credit growth in banking plus NBFC plus the lending by mutual funds and insurance companies put together. So if we see all lenders together, probably I think the credit growth may not be as robust as it looks like to be. Because there has been some loss of growth by NBFC sector particularly, and part of it has been captured by the banking system. When it comes to deposits, I think it's more of the velocity of money, it's more on the multiplier effect which the commercial banks provide, and therefore more of lending means therefore more of deposits getting generated, because disbursal of loan to a particular corporate would go as a deposit to some of his vendors or some of his constituents who are being paid from that loan amount, and so on and so forth. The cycle increases and you have multiple rounds of that money getting rotated and creating an economic value. So I think if we go by that premise, I think a robust credit growth overall in the system would result in more of deposits getting accreted and all, because I don't see a loss of deposits by banking system getting shifted to even mutual fund industry, because that has also got more or less stagnated or little slowed down on their side. So where is actually the saver putting his money? Either in physical assets, and probably off late gold and silver prices are shooting up, so probably part of that saving is going into these physical assets. This needs to be analyzed. So that's why I said there, a deep dive is required to really look into these numbers, how credit growth is put vis-a-vis the deposit growth rate.
Okay, all right, Mr. Khajuria, we'll leave it at that. Thank you then for joining in on this all important day when we have our eyes out on Shaktikanta Das and his team, and let's see if he's able to stoke market sentiment a little.